Hello traders, today is the 30th of March. My name is Devil Hornsey, market and LSU trading. And today I'll be looking at opening gap trades. Okay, first of all, what is an opening gap? Well, essentially you have a closing price at the end of the London session, and then you have an opening price at the start of the next session, in the Asia Pac session. And last night we can see that US session closed the dollar versus the yen around 122.86, and then on the next open, when market started trading on this chart, we were all the way back down here, 121.74. If I go to an actual daily chart, you can see here that generally the market does not gap. There's normally a continuation from one session to the next session, and these candles all sort of overlap, or at least start from the previous day's close on the next day's open. So the gap is, a physical thing. It's normally got a catalyst. Last night, the catalyst was the Bank of Japan keeping to their word of having unlimited purchasing power of their bonds, the JGBs. Last night, they increased the amounts across the sort of term structure. So 3-year to 5-year JGBs increased to 600 billion yen. You can see that there's been a lot of buying, and they're willing to go all the way through till tomorrow to keep buying all these bonds. They essentially own the bond market, and they're just trying to keep the yields from racing off. Today, the yen is strong. That's why we saw the US dollar versus the yen come down. Obviously, the dollar here is also weak. That's been affected by a stronger euro. So a perfect storm for the dollar yen to go lower, and maybe the Bank of Japan were waiting for the euro to sort of strengthen and give them a chance to get a weaker dollar. If that wasn't their intention, if they just went out and just bought JGBs, if we look to the left, we've got 92% of traders on this platform trying to go short the dollar versus the yen. So today they think they're on the winning side. If we go back to the daily, you can see that always from the start of March, they've basically been on the wrong side of the trade. So I'd hate to think that they have been holding a short all the way through that, because I think we're going to see them feel a bit more pain as we fill this gap. So like I said, there was a catalyst. We've generally don't see a gap hold for very long. If it closes and then that becomes resistance, which is where I'm going to take profit, then maybe this monetary policy change is enough to spook the market into coming back down to test all the way down here. I certainly don't want to be holding all the way back down towards 115. I'm not even really interested in holding above 122.8. However, I will be interested to see whether or not we get a higher swing high above yesterday's highs. Especially if we do that, then that could be, this sort of structure, if you like, could it be a descending channel, just a corrective move after we had a big bullish daily inside bar breakout. So if I go back here, you can see on this day, the 24th of March, mother candle. Then we had the child candle on the 25th inside the range, and then we had a big breakout. So some traders got in, took out some liquidity above this swing high level here, 123.79. Didn't quite make it all the way to the recent sort of highs. So there's still some liquidity above the 27th of March's candle. Could obviously, it's the end of month, so we could get a rebalancing, which is why I don't really want to be holding for much longer than the gap fill. If we go back to a 30-minute chart, looking to the left, we've got this big red candle relative to this chart, where these sellers had a lot more buyers come in and accept their sell orders, and these guys bought them, and they obviously the ones that broke out to the upside. We did on this chart have market structure change. We had a double bottom here. I can see they broke through that. They came back up to test it towards the end of yesterday, and then we broke down. So I'm thinking above yesterday's close, above my take profit target, is probably resistance around 123. I need to see some sort of market move above that, come back down, test, and then a continuation higher before I consider a different trade. So the only trade I'm really interested in at the moment is this gap fill, get back up above the intraday sort of EMAs. Even if I go down to, like, say, a 15-minute chart, The 200 EMA is kind of around yesterday's close at the moment. I'll be happy with a test of that. Obviously, I've got another buy limit order down here, just because there is one more last ditch attempt for the bulls to get in. This candle on the 15-minute chart, 25th of March low, swing low, sorry. It has been tested, so it's not like it's virgin, but if you look down here, this green candle high, that hasn't been tested, so that's my buy limit. Just last ditch attempt. I'm happy to get stopped out just below that if I'm wrong, because I really don't want to be holding all the way back down, like I said, below 120 through this massive impulsive candle, all the way through these daily highs, possibly down to this double top here around 116 or down to 115 spot 5. So yeah, just an intraday short-term idea. You often see it in equities when in the after hours sort of trading, there's some news, fundamental news pop out. For us Forex traders, Bank of Japan obviously attempting to do some monetary policy adjustments, and the market just needed to reprice. Algos don't like leaving gaps, so I'm just waiting to see if we get a push up higher now, and so we'll take some profit up there. That's what I'm seeing. That's how I look at gap plays. As long as there's a fundamental reason, technical analysis gives you sort of like the sort of timing. And if you're in a trade similar, good luck, and I'll speak to you tomorrow. All right, take care.